Hello from ClearWealth Advisors. It's December 2023. After another great year, I wanted to go through the year a little bit, the year of 2023, and then show you what we think is going to happen in 2024. So we've just got the One Capital playbook fresh off the presses. And let's get started and going through that. Before I do that, I just want to wish everybody a happy holiday season and all the best for 2024. A prosperous 2024. So let's get going here. Let's talk about the major themes that we saw and that we see going forward. Global equity markets continue to rally that began late in 2022. Saw the bear market end September 30th, 2022. And then since then, the markets have been rallying. We'll talk about that a little bit. Bond yields are up further. We see a recession less likely going forward, and we've seen inflation come down, and we see that continuing to go down. So if we take a look at what's happened in the global equity markets, I'll give you a very quick summary. The Q4 of 2022 was very positive. So was Q1 of 2023 and Q2. Q3, we saw a pullback, and then we've seen a significant rally. I don't know if we'll call it the Santa rally, but we're seeing a significant rally going into the end of the year. So should this keep up, or should we hold the gains that we've earned to date? I'm putting this podcast out mid-December. You'd be very happy with what you see on your statements at the end of the year. So you can see from this chart that we've got here that the best performers are U.S. large cap. I can tell you the best sectors in the markets this year being consumer discretionary and technology sectors. Those were both up 52%. Most of those gains were led by the top 10. Top 10 are companies you probably recognize: Apple, Google, Microsoft, Amazon, Tesla, drawing a blank on the rest of them, but they're all in the top 10. So the top 10 of the big companies have been really driving those returns. So where we see some opportunity is in what we call the narrowing of the market, is the other companies outside of the top 10 that haven't performed nearly as well as those top 10, that are undervalued by historical valuation levels. So where we see some really good opportunity is going to be in the small cap sector, as well as the international equity markets. Okay, so just to further dive into that with my charts and graphs here, large cap stocks typically in the U.S. trade around a 15.6 multiple of earnings. They're currently trading at 17.8. Mid-cap companies typically trade at 16.4. They're undervalued at 15.2. And small cap companies typically trade at a premium at 21.4, but they're at 19.2. Okay, so there you can see, like, as a percentage of the 20-year average, the mid-cap and small cap categories are undervalued versus the large cap categories is overvalued. So in our portfolios, what do we do with that? We're likely going to sell some large cap companies because they performed really well, and we're going to reposition those back into the underperforming categories. And as we look to those to sort of revert back to the mean or come back up to their averages. All right. Let's take a look at what's happened with earnings. So earnings in 2023, if you look at the calendar year earnings, which is that second to last bar in each one of those graphs on the right, you can see that the earnings have been fairly low for 2023 at 0.6%. It's been positive, but low. And revenue has been about 2.3%. What I think is exciting is to look at what's going to happen next year. So the projections for next year is that we've got very strong earnings at 11.6% and very strong revenue at 5.4%, which could be further improved upon if interest rates come down and corporations are paying less interest on the loans that they have outstanding, which will add to both their earnings and their revenue. Speaking to that, I thought I'd show you the yield curve right now, and where the yield curve was in 2021, which is the bottom line there, and that's what's called a normal shaped yield curve. That's historically what you have is short-term rates are lower than long-term rates. Okay, well, the second line up, the green one, is where the yield curve was in, basically a year ago, okay, or just over a year ago, 13 months ago. So you can see we have what was called an inverted yield curve. So we have short-term interest rates much higher than long-term interest rates. And this is why the word recession's been thrown around a lot, is usually when there's an inverted yield curve, we run into a recession. In this instance, we may not run into a recession. We had a lot of different factors at play because of the pandemic. So, and now you can see the current yield curve, the blue line, which is showing short-term rates are quite high at 5.5%, and long-term rates are lower. So if you're looking at mortgage rates out there, you'd actually see that if you get a one-year mortgage, you're going to pay a higher rate than you would with a 5-year locked-in rate, and that's because of this inverted yield curve. As we move forward throughout next year, we anticipate seeing the yield curve moving down a bit more, probably closer to this, what it looked like on December 31st, 2022. Time will tell, but the Federal Reserve Bank in the US and the Bank of Canada are both indicating that rates should start dropping sometime mid next year. We use different vehicles with our portfolios to add return. One of them that we use is something called private credit. And private credit can add some diversification. It can also add to the return in the fixed income side of our portfolio. And so what this graph shows is the bottom line, the gray line, is what the treasury rates are. So just like the yield curve showed, current treasury rates are around 4.5% to 5%. If we can put some private credit in there, we can add some diversification, we can add some yield. So currently the added yield right now is about 6.9% over the treasury rate. So if you look at that, that's up around 11, 12%, which is a pretty nice return. There's some risk to the private credit side, so we wouldn't want to put too high an amount of percentage of your assets into the private credit area. However, adding a portion of your fixed income portfolio into private credit can add some return, which we've done to those clients who own fixed income in their portfolios this year. I'm gonna come off that slide and get into sort of the economy more, looking at household savings and liabilities. So what these two graphs show is that during the pandemic, we had significant savings occur for household balance sheets due to people not spending money, government subsidies, what have you. There was very high savings rate, and we still have an excess amount of savings in the economy of about $200 billion. So we could call that dry powder. That's money that's kind of ready to be spent into the economy. It's been obviously coming down. It was up at 6 trillion. So, but there's still money left that can be spent and fueled into the economy. But you can see that personal savings rates on average have come down. So, I'd like to encourage our clients to continue to save. Savings the way to getting to financial freedom, one step at a time. And, let's not let the overall averages impact your balance sheet. If you can continue to live on less than you earn, save the difference, let it stay invested, and have the magic with compound interest. Work on it. You're going to get into a position where you've got a lot of financial independence. You can also see the graph to the right here shows what's happening with household liabilities. So liabilities came way down in the pandemic. They reached sort of an all-time low as a percentage. In the pandemic, they've come back up again, but they're still, at a relatively good level, which means that households aren't spending an undue amount of their monthly expenses towards paying off debt. Okay, and they could spend that money in the economy, which is going to fuel corporate growth, which is going to then turn into revenue and earnings for these companies, which are going to provide some lift on the stock prices. Something else to look at is like what's happening with the labor market. So really, the labor market is still very tight. It was definitely one of the contributors to inflation and these high interest rates that we have. You could see that it's still sort of at these high levels, but the job openings are coming down, and labor force participation is quite high. So this is something that we still have to be mindful of. However, these higher interest rates are having their impact on the economy. It is slowing some sectors of the economy down. There are some layoffs happening, and that should expand sort of this the unemployment rate to a little bit of a higher level, which would actually be a good thing because it'll reduce the pressure on wage growth, which helps reduce inflation. Next slide, bridging right into inflation. So this historically is inflation. You can see way back in the 80s, I actually remember this. I moved to Vancouver in the 80s, and I heard about, it was one of the only times we've seen a significant drop in house prices in Vancouver because mortgage rates were so high. I think mortgage rates at that time were up around 20%, 25% to get a mortgage. So, I know mortgage rates seem high today at 5, 6, and 7%, but compared to back then, they're very low. So, but what we can see more currently is we've had low on inflation for a long period of time, and then after the pandemic, we had this big spike in inflation to almost 10%. I think it got up to 9%. Now we've seen that dramatically come down, and what's precipitated those decreases is the increase in interest rates. So, the Federal Reserve and the Bank of Canada are still looking to reduce the what interest rates or what inflation is, so that they can bring down interest rates, and we hope to see that continue into 2024. This is an interesting graph. This shows, where people hold their mortgages, particularly in the U.S., but it's like how many people, as a percentage, are locked into different rates. So you can see very small percentage are up around where current rates are right now, and the majority of people have got a rate right now locked in under 3%. And in the U.S., you're able to lock in your rate for 30 years. Wouldn't that be nice to be able to lock that rate in for 30 years when it was around 2%? So what this means, again, going back to the household liabilities, there's a lot of concern in Canada that we've got all these mortgages renewing, because ours renew typically every 5 years. But in the U.S., which is has a much bigger impact on markets, their household expenses aren't going to change as much due to renewing mortgages, and so therefore they're still going to have discretionary money to spend into the economy. I'm going to skip these last slides and just sort of get to the summary here. So our views, the recession is probably the event, the probability of a recession happening is much lower, and it may be deferred, may not even happen, right? Housing and labor markets maintain some pressure, and narrow equity markets create opportunities. So we're always looking for ways to reduce risk and improve return through our rebalancing strategies, through identifying securities or asset groups that are undervalued, and we will be continuing to do that into 2024 as things proceed. But we're cautiously optimistic that 2024 will be another good year. 2023 was a very good year. And so with that, I wish everybody a Merry Christmas, Happy Holidays, and we'll talk to you in the new year.